Monetary policy. So, monetary policy is controlled by the Central Bank of the United States, which is, in the United States, it's the Federal Reserve Bank system. In other places, it's the Bank of Japan, the European Central Bank, the Bank of England, etc. And the whole point of these banks is to promote full employment, maintain price stability, and encourage long-run economic growth through control of the money supply and interest rates. So essentially, monetary policy is where the central bank tries to limit or control fluctuations in the business cycle. So there are two types of monetary policy. You have expansionary monetary policy. It's sometimes referred to as easy money. This is designed to counteract the effects of a recession and return the economy to full employment. So expansionary monetary policy is used when your aggregate demand is in the recessionary gap. Conversely, you have contractionary or tight monetary policy, and this is designed to counteract the effects of inflation and return the economy to full employment. So when your economy is in the inflationary gap, contractionary tight monetary policy is used. The Federal Reserve System has 5 basic tools they may use to expand or contract the money supply. The first one is the discount rate. This is a rate that, and it's an interest rate that financial institutions pay when they borrow money from the Fed, because they have to have reserve requirements, they have to meet that reserve ratio, and if at the close of business they don't meet that reserve ratio, they don't have enough money in cash currency in their vault, sometimes they have to borrow from other banks. They first go to other banks to borrow because it's usually just a 24-hour or less loan until they get enough demand deposits to satisfy their reserve ratio. And it's typically very easy to get another bank to give you some cash from their reserves, no problem, unless your bank's not viewed as very stable or not likely to get paid back very quickly, as in less than 24 to 48 hours. And in that instance, the bank has to go to the Federal Reserve and use the discount rate. It's the lowest interest rate available in an economy in the United States, but borrowing from the discount rate is not a good signal you're sending to other banks, and so banks typically try not to borrow money from the Fed. So it's not the most frequently used tool of the Federal Reserve System. They have reserve requirements. It's the amount of money that banks must keep in reserve. They cannot loan it out. They have to have at least 10%. The Fed set this reserve requirement anywhere from 5 to 20%. It typically hovers around 10%. Right now, it hasn't changed very much from that. And then the Fed can use interest on reserves. It's a new tool to raise interest and discourage loans, or they can lower the interest on reserves to encourage loans. But this is a very new tool. It's only been around since, I believe, 2008-2009 recession. The most frequently used, and therefore kind of the most important monetary policy tool of the Federal Reserve System, is called open market operations, or OMO. You have to know open market operations. This is when the Federal Reserve buys or sells government securities on the open market. So when they buy government securities, they take money from the Fed and put it out in circulation in the economy. The money supply increases or gets bigger. You use the acronym BBB. Buy bonds, big bucks. It's when the Fed wants to increase the money supply, usually during a recession. When they sell bonds, they put bonds out in circulation and take the cash for bonds in. So cash goes to the Fed, bonds go out. This is when the money supply decreases or gets smaller. This is usually the tool that's used, or selling tight money supply. Tight money is usually used during the inflationary periods to decrease the supply of money. It's the most frequently used tool of the Federal Reserve System. It's controlled by the Federal Open Market Committee, and they meet 8 times a year to set interest rates and decide whether or not they're going to buy or sell bonds, or occasionally they don't do either. Now, the 5th tool is called the Term Auction Facility, or TAF. It was started in December of 2007 as a response to the economic crisis. The interest rate on a term auction facility loan, or stop-out rate, is most likely between the federal funds rate, which is what banks use to borrow from each other, and the discount rate. The term auction facility is a tool of expansionary monetary policy. It's only used when the economy is in recession. So, monetary policy, the federal funds rate is interest rate that banks charge each other for overnight loans to make sure they meet those reserve requirements. The Federal Reserve System is the monopoly or only supplier of banking reserves that they can change the reserves through open market operations where they buy or sell bonds. The open market operations cause a change in the money supply, and this affects the federal funds rate. The interest rate, which is the nominal interest in the economy. So the federal funds rate, when you consumers get individual or private loans, it's usually just 1 or 2 percentage points above the federal funds rate. The banks give each other lower interest. Monetary policy has two basic tools. It's either expansionary or easy monetary policy, which is used when the economy is in recession and output and employment decline. So when you're on the inside of your PPC curve. During expansionary monetary policy, the Fed buys bonds for big bucks. They decrease the interest rate for the federal funds rate, which is, again, the rate that banks use when they're borrowing money from one another. Contractionary or tight monetary policy is used during the inflationary gap when output and employment have increased but need to be controlled to ensure stable, consistent growth. And they use contractionary monetary policy to sell bonds, and they increase the federal funds rate to discourage lending. So this is what it looks like. You have the graphing expansionary monetary policy. It's a 3-graph progression. So we're going to talk about the money supply, and we're going to talk about how the money supply graph relates to the investment demand graph, which will finally relate to the aggregate demand and aggregate supply graph. So, what we see here is the quantity of money increases, and then we have the quantity of investment that increases as well on our investment demand graph. So those shift to the right for money supply, which is an increase in the money supply. When the supply of money goes down, the price level goes down, which is the price is interest when you're talking about borrowing. And so what happens is we see that we shift aggregate demand, because now that when we go back here, we see that more people are demanding loans at a lower interest rate. That increases the investment component of aggregate demand, and that shifts our aggregate demand curve to the right, which this would be an example then of expansionary monetary policy, where the Fed is trying to help the economy move out of the recessionary gap and back into stable economic growth. Conversely, when we see the money supply shrink, so we shift the money supply curve to the left, and the money supply curve is again vertical because it is controlled absolutely by the Federal Reserve System. They control how much money is in circulation. So what we see then, when the supply of money decreases, the price for borrowing increases, so our interest rate or our price level goes up. And because of that, our aggregate demand, our investment demand decreases, which is one of the 4 components of aggregate demand. So when aggregate investment demand decreases, then aggregate demand also shifts to the left. This would be using contractionary monetary policy, in which the Federal Reserve is attempting to get the United States economy out of the inflationary gap and back into healthy, stable growth. So, monetary policy flow chart. The open market operations buys. This is expansionary monetary policy. Buy bonds, big bucks. They increase the money supply. Interest rates decrease. There's more investment, more production, more jobs. Demand, aggregate demand, increases. And then eventually prices rise. During contractionary monetary policy, the open market operation sells bonds. They decrease the money supply. The interest rates increase, there's less investment, less overall production, fewer jobs, demand decreases, and prices fall. So we have a net export effect for monetary policy, which net export again is part of aggregate demand. So recessions require expansionary monetary policy. So open market operations buy bonds, big bucks for the money supply. increase the supply of money, they lower interest rates. Foreign demand for financial assets decreases because interest rates are lowered, and so there's less interest to earn for foreign investment. The dollar depreciates, exports are cheaper, imports are more expensive, so net exports increases because when exports become cheaper, more stuff goes out of the United States economy, but more cash or money flows into the U.S. economy. So net exports increase, aggregate demand increases, and that strengthens the easy monetary policy which is used during expansionary monetary. Inflation requires contractionary monetary policy. So using tight monetary policy, the open market operations sells bonds because they want to reduce the money supply and they raise interest rates. Foreign demand for dollars for financial assets increases because now the interest rates have gone up. It makes it more profitable for foreign investors to purchase or invest in foreign financial assets, in the United States. The dollar then appreciates, exports become more expensive, imports become cheaper, and so money flows out of the United States while goods are flowing into the U.S. economy. Net exports decrease, aggregate demand decreases, and this strengthens tight monetary policy. So there are several advantages to monetary policy over fiscal policy. Monetary policy is led by economists whose goal is to stabilize the economy while encouraging economic growth. Economists are more concerned with the long-range effects of their actions. They are not politically motivated because they're not elected. They are much more quickly able to take action than politicians are, and their actions can be more precise and usually demonstrate a much greater understanding of economics than elected officials. There are problems with monetary policy, however, it's not a perfect system. There's timing gap where they have to recognize and see the effects of their actions, so they might be able to respond much more quickly, but it might take a little bit longer to recognize and see the effects of monetary policy. Monetary policy tends to work best for inflation. It is proven to be less successful at stopping a severe recession. Because monetary policy can make loans less expensive, but it cannot force banks to actually give loans. It cannot force businesses to take out loans for investment spending, and it cannot make consumer confidence increase and lead to more spending. So those things tend to be very difficult to make improvements in the economy because the Fed and monetary policy cannot force those three components of the economy to take the actions that will actually help.